and welcome to BloombergQuint. You're watching IPO Adda, and the company in focus today is Veranda Learning Solutions, a company based out of Tamil Nadu and catering to the Tamil Nadu market and the Karnataka market with respect to education, especially with respect to competitive examinations and scale programs for various age groups there. And joining me is Mr. Kalpathi S. Suresh. He's a form of promoter of SSI who acquired Aptech, and then it was sold off to Rakesh Jhunjhunwala, as we all know. And he's now again entered into this education venture with his flagship company, Veranda Learning Solutions. The company is coming out with an IPO on 28 with a price band of 130 to 137, raising nearly 200 crores. And Mr. Suresh is joining us today from Mumbai. Thank you, Mr. Suresh, for joining us on BloombergQuint. To begin with, sir, give me an idea of how you are stacking up this new education vertical and the business model that it has.
Thank you, Sajid, for the opportunity. Veranda Learning Solutions is founded with the principle of being a hybrid company. So all our programs are available in online and offline hybrid formats. We exist across 4 verticals. Veranda Race services students and learners who are focused on state and central government exams. We today exist in multiple vernaculars. We exist in Tamil, Malayalam, Telugu, Kannada, Hindi, and English. We provide learning services for students aspiring for CA Foundation, CA Inter, and CA Finals. Also for people in the UPSC, for people who want to write the IAS exam. So we exist on prelims, finals, and mock interviews. And also in terms of software upskilling, over 100 different programs in a B2C, B2B, and postgraduate program formats. The core philosophy of Veranda itself is to provide very high quality education that drives outcomes. And third and most important, and for me personally, is that we make it available at a price that's affordable to what I call as the real India. My own humble background and beginnings as a family, I passed out of IIT Madras in the mid-80s. If education had not been so heavily subsidized, my family background wouldn't have afforded me that education, and I wouldn't have been in front of you in this podium and position today. So for me, it's very core and a personal philosophy that we make it affordable to the real India, and in some sense contribute back to democratizing education to a much, much larger audience.
You're catering to a section which is basically from 16 to 35, primarily that because either you're looking at entrance examinations for UPSC or for CA chartered accountancy, or for skills if you're working in an environment. What is the kind of growth which you see in each of the segments? Because we have today a lot of educational institutions. There are cities which are known for this kind of examinations and skill providing entities. How do you cater to this thing? And you're currently based out of Tamil Nadu and Karnataka. Is there a plan to expand your horizons beyond the 2 states today?
I will talk of first the state and central government exams. The numbers sometimes could be quite surprising and staggering. In some of the larger states in India, the number of people who register to write these state and central government exams is sometimes bigger than the number of people who register to write an IIT, JEE, or NEET exams put together. And this is just coming from 1 or 2 states of India. So the state and central government exams is a very, very significant test prep opportunity, which allows people to prepare for government exams as against private institutions. This is largely driven vernacular. So as I mentioned, over the last 12 months, we have expanded our footprint from just being available in Tamil to being available now in Kannada, Telugu, Malayalam, Hindi, and English. Going forward, as part of the IPO proceeds, we expect to invest in getting across to Odia, Marathi, and Bengali. And that gives us a national footprint in a segment that's possibly one of the largest in test prep in India. The second one that we are focused on is the software upskilling vertical. Depending on the publication that you read, the skill gap that has emerged in India is between 5 and 6 million. And many of the networks that produce these volumes of people, including ourselves in an earlier avatar, those engines are not firing that well today. What used to be a requirement 20 years ago of about 100,000 for the entire industry, today just the top two IT consulting companies have a requirement in excess of 100,000 every year. What used to be IT jobs created by these IT consulting companies, today it is not just the IT consulting companies, but the health tech, the insurance tech, edtech companies like ourselves, or fintech. All of them are looking for the same IT technology skills. And if you look at some of the IT departments of large organizations like banks and insurance companies, their IT arm would be sometimes as big as some of the top 100 IT consulting companies themselves. So today, because of the way India has grown and the segments in which it has grown, there are many people who are requiring the same skills, and the engines that used to produce them are not firing much anymore. So for us, that's a significant opportunity being driven by demand. The type of uptick in salaries of IT consulting job starting salaries, it has almost doubled in the last 6-7 years. And that clearly shows that there is an issue of supply meeting that demand. So as I mentioned, we had in our earlier avatar, when I remember when we listed the company in late 94, 95, we were a one center company with a single center in Chennai. And in 2000, when we listed on the London Stock Exchange, we had built our network close to 1,000 locations in India. So it took us 5 years the last time around. Hopefully, with the experience that we have had and with a strong management and content portfolio that we acquired through Brainforce, hopefully we'll be able to do it much faster this time around. But our focus is to take this deep into tier 3 and tier 4, because if we believe that across the top 15, 20 tier 1 cities in India, that has already been dug deep into. And that's not delivering to the type of demand that has emerged. So it has to come from all parts of India. And that's an experience we have had of building some deep networks for software education. So we plan to be able to combine our prior experience and strength with Brainforce, which is the company that we acquired. And that's going to be our second significant engine of growth.
Currently, if you look at your revenues, it's coming from two categories. One is Raise and one is Edureka, which is there. Brainforce is not catering much to the revenue. When do you see that segment catering to the revenue much to your revenues?
So just to clarify, Brainforce is the company. Their customer-facing brand is Edureka. And we expect these two to be our significant contributors over the next 3-4 years. For me personally, of course, software is something where we cut our teeth first time around as entrepreneurs. So for me, it's a lot of going back to delivering what we do best. And we are coming into a very exciting environment where the demand compared to the last time around has probably grown more than 10 times.
Okay. Recently you made a private placement in December at 130 rupees a share. Can you take us through how did you value the company? Because just few months prior to that private placement, the shares which were issued were at much lower rate. So just wanted to understand the valuation, how you're valuing the company.
I think a significant part of the change that really happened was our investment in content and process to go across vernaculars. We expanded from Tamil into 5-6 other different languages. That made a significant difference to the type of demand we can now service going forward into the next few years. The second one was coming together of a pure play online company, which Edureka was, combined with the experience that we as promoters have had for over 3 decades in building out significant offline hybrid networks for software education in India. and the type of growth that it sets the company up for. I think that made the significant difference. The people who invested in our pre-IPO placement in December, where we raised about 40 crores at the price of 130, are clearly people who found value in the story and in the business that we were building. Some of them are quite seasoned professionals who understand this market and the type of risk return rewards. For us, it's very heartwarming that such professionals and veterans have found and are today part of our shareholders. The IPO is coming at a price around the same price. 130 to 137 is the price span. And we are very happy to be able to offer not just HNI and retail, but also our qualified institutional buyers at about the same price at which the pre-IPO placements were done.
My question was with respect to the fact that you've been loss making for the last 2 years, and while the company that you acquired, Edutech or Raise, they have a history of more than 5-10 years, but your company has a history of only 2.5 years, and in last 2 years it's been loss making. So what is the timeline or path to profitability, or at least operational profitability going forward?
Veranda is a young organization, and the last couple of years have been years of investments that we have made. Investment in content, investment in processes and technology platforms, and investments in high quality people and acquisitions. That is sort of what is reflecting. But what this is also done in terms of the investments that has been made, it has set the stage for growth that is coming in the next 3-4 years. Be it in terms of processes, and I'll just take a step back and just talk of one of the processes that we have put in place. Based on the experience that we have seen, especially some of the offline companies that have been hit very hard because of the national lockdowns, we have put in place a process which we internally have patented called pandemic proof, which essentially means that if tomorrow there is another lockdown that happens for weeks, months, or possibly even a year, we have processes in place where all our businesses, whether offline, online, technology, or content development, will happen without a hitch for the company and for all our students and learners. It will switch seamlessly from one day to another, irrespective of when the lockdown comes and how long it is. So those are some of the things where we have invested in building out this platform and setting the stage for growth. As a company and personally as a promoter, I strongly believe in building profitable businesses. We will set the stage for aggressive growth with profitability. So this has been a year of an investment for us. The rewards of that investment is expected to come in the next 3 to 5 years. And we clearly want to build a business that will be profitable, not just growth alone.
So from a scalability point of view, you're working on a PDP model where preferred deliver partners are delivering your educational content, whether online or in a hybrid mode or offline mode. How do you plan to ramp up the PDPs going forward? Because I understand that for growth initiatives, you put some figures from the IPO. So where do we see this ramp up happening? You said you want to get into Odisha market and other markets, but in terms of number of PDPs which you're planning to set
up? So first is the content going across vernaculars allows us to sell these programs online into many of these markets. So we will continue to aggressively grow our online presence. Where we are coming from is whether it is online or offline, it is a customer's choice as to which channel that they would use to partake of our education. We are not going to be able to limit their choice, and hence we will expand aggressively in our offline hybrid format too. And that I think is where the experience that we have had over 3 decades in building out some of the largest offline hybrid networks in India comes in combination to the acquisitions and the quality of content that we have acquired, along with the top management that we have done. I think it's a great combination. I am seeing in every conversation I am having with some of the top management of each of these verticals that I have, I am as excited as some of them. And we are seeing this making a significant difference, because to build such large networks, which we did, the number of learnings that we had and the experience that we got through, all of that is available on day one to this platform. So the 20 years of experience is all in play where this is concerned. And we, as I mentioned, the last time it took us 5 years to go from a 1 to 1,000. Hopefully this time around, we'll be able to do it much faster. We understand this country and its geography, district to district, town to town. So we will leverage on this very significantly. And going forward, one would start seeing the results of this and the fruits of this expansion.
Of the student base which you have today, around 42,000, what percentage would be offline and what percentage would be online?
Today, because of the lockdowns that have been a significant part of what we have seen over the last 2 years, it tends to swing online. But every time we have seen that the lockdown, there is an abatement in terms of stricter norms, controls on movement, the offline tends to pick up quite aggressively and fast. So my guess is that the offline format where somebody wants to go to an institute near their house and learn, I think it's still live and kicking. If you look at the developments in the last 6-12 months, some of the pure play online platforms have started rolling out their offline hybrid formats. Clearly goes to show that across the industry, they are seeing the resurgence of the offline formats. As I said, Veranda Learning core founding philosophy is to be an education company that leverages significantly on technology, which is something we understand very well. But we will be available in all formats. We are available online, offline, hybrid, and it is for the student to make the choice. We will make ourselves available across all channels. And that's been a day one philosophy.
Currently, what you have a model is you are taking revenues from your BDPs and there's a revenue share which is there. Can you explain that revenue share model to us? How you are accounting for the revenues?
So the way it works, and this began based on the experience that we have had in running large networks, Sajid, is the students are students of Veranda. The partners that we have are partners who provide delivery services, and they get paid for delivery services provided on regular basis based on the quantum of delivery done, which is subject to audit. So as much as a student who joins us online, pays Veranda online, and is a student of ours, whether the student is joining online or offline, they are our students, and the fee is collected by Veranda. And Veranda will work with various partners to optimally provide the delivery for these students across geographies, whether it is online or offline. So for us, online or offline does not change the way we work our account. It is only a way in which we allow our students and learners to partake of the content that we have.
What about the revenue share model that you have with them?
We actually don't have what I would call as a revenue share model, but we pay our delivery partners sometimes as much as 75%, sometimes 60%, depending on the type of program and the type of vertical for whom they are partners. I have models which we call campus in campus, where we provide this education in dedicated colleges and campuses, where again the percentages change.
Okay. What about the margin picture here? Because currently we can't look at the margin because you're loss making and you're in the expansion growth phase. But given the kind of model that you have, what is the kind of margin trajectory that you have, or what is the range that you can see once you're profitable, and this model allows for it?
So for a business like ours, a common expense that we have is marketing and brand building. While we will continue to spend more, given the expansion that we are doing and the expected growth that it should drive, as a percentage, we expect our cost of customer acquisition and cost of brand building to come down. That will drive up our profitability. The formats that we have, whether it is online or offline, inherently significant gross margins. The ability for us to find novel ways and innovative ways to drive our customer acquisition costs will drive our profitability going forward. I think from a return on equity perspective, apart from the percentage of sales, which could be our margins, the type of growth that we will be able to achieve, given the investments that has been made in all formats of technology content, that should significantly improve on our return on equity. While the percentage of sales as a margin at some point will start stabilizing.
You haven't given us the number, but you have said everything else.
I understand. So I think while we spoke of the preferred delivery partner model, the second advantage that we have, and this is again an experience that we have had in the past, it leverages significantly on partners' capital. So while we are talking of hundreds of locations that we could potentially expand in India, most of this will be an asset-light model, and that will also ensure that there is a significant return on capital that we can generate. And again, this has been an experience that we have had from the past that we've been able to bring to bear.
So just to get an idea, you spoke about that cost of acquisition and marketing cost is something which you have to undertake. Currently, what is it actually?
So we spend on multiple platforms, and I'll sort of try and differentiate it. Typically in state central government exams, we are finding that there is a reach to a customer that gets driven optimally through television and print. We do also sprint on digital, but we're finding that as an access. We're also finding innovative ways based on the customer profiling to be able to reach them at a much lower cost. From a software upskilling perspective, we are finding that digital drives more of optimizing our cost of marketing compared to a print or television as a medium. So there is a lot more leaning towards that. We expect our spends to go up in terms of marketing going into the future years. But as I mentioned, the growth in top line that we expect based on investments we have made, we'll keep that as a percentage to ensure that we are able to deliver on margins. So these numbers are dynamic, Sajid.
Okay.
Again, because
but on an average, suppose if you're getting 100 rupees in revenues, what is the kind of percentage or how much you're spending in acquiring that customer?
In the last 12-18 months, those percentages have been higher because we've been investing in building out the brand. Going forward, we are moving into a phase of leveraging of what we had built. So it is expected to come down. I'm not able to put a finger on the number, but it is expected. So it would be on a trajectory where the percentage will keep going down.
If I look at your balance sheet, you have nearly 160, 170 odd crores of debt. You are paying off around 60 odd crores through the IPO proceeds. You still be having having 100 odd crores on your books. What is the kind of cash flows that you're looking at, given the fact that you're loss making? Is it likely that you will come back into the market raising fresh funds for your growth and deleveraging?
The current debt in the books of the company is about 60 crores of debt, which has come specifically for acquisitions, which is going from the IPO proceeds to close. About 25 crores is based on a commitment that's coming, again, connected with the acquisitions we have made, that's being closed from the IPO proceeds. That sort of brings the net debt to possibly about 40 crores or so. The company would have significant cash in its books, much above the levels of debt that is there. So from a net perspective, the company will be net cash. As I mentioned, we are very clearly focused on building healthy, profitable businesses. So the current round of 200 crores that we are raising sets the stage with enough and adequate capital to be able to build for the next 3-4 years. As I mentioned, the company is like the 2 acquisitions that we had done in the past. The company will continue to look for opportunistic acquisitions where it makes sense, where it can help build further on shareholders' value. If they should come, we will look at ways to put structures in place. But as I mentioned, it has to be opportunistic. It has to take up the shareholders' value. But given the ravages that the COVID and the resultant lockdowns have created, there are opportunities that we are seeing.
Suresh, your model is more of a traditional model, and you have now ventured into hybrid as well. But if you look at the Edutech space, where we have seen a lot of new startups coming in, unicorns already in place, many having $40 billion valuations, how do you compare your model with their model and your valuation with their valuation?
So if you just look at the acquisition we did in Bangalore, Edureka, it's a pure play online business. They have no offline footprint at all. I would even go hazard to mention that they are probably one of the oldest online businesses in India, because they were online 10 years ago, when online software education was really not spoken about much at all. And they started as 10 years ago being an online software upskilling platform. So it's a pure online platform, not very different. Arguably one of the top 5 in that space in the country. Valuations apart and the metrics of such valuations. But we had a chance to be able to acquire them at a very competitive pricing compared to some of the pricing that you just mentioned. But it's a pure play online business that we acquired. We are building around them an offline hybrid format. So it is as cutting edge and as new age as some of the businesses that you mentioned, which they are. On top of that, we are building a wrapper which is purely based on the experience that we bring to the table. So we will enhance it beyond what the current new age edtech companies are, which Edureka is already. So, I'm not sure how these valuations are done, but we think we got them at a great valuation. And the offline hybrid formats that we are building will also make them significantly profitable. So that's our goal. We want to maintain that cutting edge. We will continue to be online as many of these businesses are, and our online offerings will be some of the best in the country in the way we offer them. But we will also create hybrid formats around them.
Just a general question. One of the biggest challenges for you would be the attrition rates which are coming in, right? For your mentors across your centers. If I'm not wrong, it's between it was 22% or so for the first half and 37% last financial year. How are you managing that attrition rate? Because at the end of the day, it's a people business, and your success rates depends upon how your mentors are there. Right?
So I think so I'll sort of split it into 2, Sajid. One is in terms of education, non-tech, right? So we use a lot of tech to build our platforms, where we use a lot of technology skills. We in the software vertical, we also provide education in some of those same tech skills, whether it is a full stack or data sciences or AI, ML or cloud architecting. Those are areas where the attrition rates are aligned with that industry, which is tech and IT consulting type of industries. The other one is a pure play education industry where the attrition rates are lesser, more benign than it is for the IT consulting companies. Uh, as I mentioned, we have gone through a couple of acquisitions and we are consolidating. So some of what you have seen is possibly relating to those, but also the type of attritions one sees in the tech space. Now, the big difference that's going to happen is we are putting together a stock option plan for all our top management and key management employees. And coupled with the fact that we could possibly be a listed and trading vehicle, also gives people a chance to understand what their stock options uh, and the vesting that happens in terms of its value. I think that will also help us not just cut back on some of these attritions to take it below industry numbers, but I think more importantly, it will ensure that as we build the value for Veranda, it is in line and aspiration of our key management and employees. And I think that will play a very significant part uh, in aligning our employees' goals, aspirations to what we are building out for the company itself.
Suresh, it's a pleasure talking to you. The Veranda Learning Solutions IPO opens on March 28th and closes March 29th and closes on March 31st. The anchor being open on March 28th. The pricing of the issue at 130 to 137, giving your company a market cap of a little over 700 crores. That's all from us. Thank you for watching the book.
Thank you. Thank you.